The FDIC is a scam, and I'll tell you why. You've probably seen it before. Your deposits are insured up to $250,000 by the FDIC. Sounds safe, right? And very official. But what if I told you the FDIC is one of the greatest illusions of security ever sold to the American public? It's a ticking time bomb built on bad math, political pressure, and a false sense of safety. Today I'm going to tell you how it works, how it's funded, and why it's so misleading. Let's break it down. What is the FDIC? The Federal Deposit Insurance Corporation. It was created in 1933 during the Great Depression. Its mission? To prevent bank runs by guaranteeing that even if your bank fails, your money is still safe, up to $250,000 per account. In theory, it sounds like a great idea, like most things from the government, but it's a house of cards. How is the FDIC funded? Let's take a look. The FDIC isn't funded by taxpayers, at least not directly, which usually means in the end, it's 100% funded by taxpayers. It's funded by premiums paid by the banks into an insurance fund. Think of it as like a pot of money that's supposed to cover any failed bank's losses. But here's the kicker. The fund holds about $120 billion to insure, get ready, over $10 trillion in deposits. That sounds a little off. That's less than 1.3% coverage. It's like having $1,300 cover a $100,000 house if it burns down. Interesting. Here's how it's fraudulent. The FDIC creates a false sense of security. People don't care where their money is parked because people believe it's insured anyway. This lets the banks take on massive risks with your money. And when things go wrong, which they always do, like they did in 2008 or in 2023 with the Silicon Valley Bank, the FDIC doesn't have enough to cover all depositors. So what happens then? The Fed steps in, the Treasury steps in, they print money or borrow it, or both. Translation, you, the taxpayer, bail out the system, just not through the front door. That's the trick. The FDIC is a polite lie that hides a messy truth. If a real banking crisis hits, the insurance fails and the government just inflates its way out of it anyway, destroying the dollar in the process. Again, us footing the bill. The moral hazard. Insurance only works if risk is priced accurately, but the FDIC doesn't do that. It's a fiat system. Risky banks pay similar premiums to safer banks. That's like a reckless teenager paying the same auto insurance rate as your grandma. This leads to what economists call moral hazard. It's when people take more risks because they don't bear the full consequences. The FDIC, in effect, rewards risky behavior while punishing prudence. Now, to be fair, the FDIC has prevented a lot of panic. It's been instrumental in avoiding full-blown bank runs since the 1930s. Yes, that is technically correct. The cost of that claim is systematic fragility. People don't ask questions. Banks grow too large, risk multiplies. Instead of protecting depositors, the FDIC props up reckless, too-big-to-fail banking culture that requires even larger bailouts when things go south. Again, which they always do. So what's the alternative to this? True stability comes from transparency and accountability. Let banks compete on risk. Let depositors actually care about where they put their money. Private insurance, more sound banking, or maybe, just maybe, a return to something real backing our money. Because a system built on illusion is only stable until it isn't. The FDIC is not what you think it is. And the next time you see that little sticker, ask yourself, if it all collapses tomorrow, who's really bailing out who? If you found this video valuable, hit the like button, subscribe for more unfiltered economic truths, and drop your thoughts in the comments. See you in the next video.